For years, the corporate credit market has been built on one powerful assumption. If a loan or bond is rated investment grade, it must be safe. But according to PIMCO's chief investment officer, that assumption has become very, very dangerous.
Moody's now warns that nearly $300 billion in private credit could pose systemic risks to the U.S. banking system.
Private credit is beginning to unravel, and the consequences may be far bigger than most investors expect.
Today, global credit markets are being reshaped by forces we haven't seen in nearly a generation.
These forces include the explosive rise of private credit, the retreat of banks, and a weaker Federal Reserve safety net. What's emerging is a financial ecosystem that is bigger, faster, and far more fragile than before 2008. Bloomberg reports that more than 1 in 10 private credit borrowers are now deferring interest payments.
At least 45 companies have already been taken over by their lenders, the highest number in 6 years.
Even private credit pools managed by major firms like BlackRock are showing signs of stress.
The critical question now is whether banks are truly insulated from these risks.
After the 2008 crisis, banks reduced lending, and private funds rushed in to fill the gap.
Today, private credit in the U.S. has reached $1.3 trillion, nearly half of all commercial bank lending.
While this sounds like diversification, it has actually created new and hidden risks.
Leverage is one of the biggest dangers in the system today.
Borrowers, private credit funds, and even fund investors have all taken on debt, often from banks themselves.
Moody's estimates U.S. banks have lent over $585 billion directly to private credit and private equity funds. Another $340 billion exists as future commitments, increasing hidden exposure. PIMCO warns investors are outsourcing their judgment to rating agencies instead of doing real analysis.
Many investors now treat investment grade and labels as guarantees of safety.
But in today's market, that confidence may be dangerously misplaced.
Private credit loans are issued by funds, not banks, and operate with far less transparency.
Competition has pushed lenders toward looser standards and overly optimistic assumptions. Many companies are now owned by private equity and financed entirely by private credit.
This makes their true financial health invisible to public markets.
To veteran investors, this looks eerily similar to the pre-2008 complacency.
PIMCO warns that if the economy weakens, credit losses could rise sharply.
Regulators are now scrambling to catch up with a market they allowed to grow unchecked.
The SEC and global watchdogs warn that risks are being hidden by inflated credit ratings.
Banks are now lending heavily to the very non-bank lenders that replaced them. This creates a dangerous feedback loop of leverage, opacity, and interconnected risk.
History shows rapid loan growth often precedes asset quality collapse.
If private credit begins to fail at scale, the fallout could rival or exceed 2008.
Private credit is fast and profitable, but speed often hides danger.
Without transparency and oversight, losses can spread before anyone sees them coming.
Private credit is now systemically important, yet largely unregulated. The risks are no longer concentrated in banks, but scattered across funds and investors.
This creates opportunity,
but also unprecedented danger.
The question is no longer whether private credit matters, but whether we are prepared for its collapse. Let me know your thoughts on the private credit dilemma in the comments below.
Thank you for watching, supporting my work, and I'll see you again tomorrow.